With every passing day, more and more news articles and papers on global warming and its effects are flooding the internet. The climate is in fact changing, and it is indeed too late to stop it. But what if the effects of climate change do not stop at natural disasters? Experts predict that an economic change is certain with climate change. 3 recent research papers by 2 groups of economists suggest that when public exposure to information about climate change spikes, investor preferences also shift, altering the performance of sectors of the stock market. If we start to play the blame game, companies like Coca-Cola, PepsiCo, Unilever, and Britannia were claimed to be one of the top pollution-causing companies in the world. Prices of companies like Coca-Cola, PepsiCo, and Nestle are witnessing an exponential decline, whereas green stocks are witnessing a spike in their prices.
Climate change refers to long-term shifts in temperatures and weather patterns. These shifts may be natural, but since the 1800s, human activities have been the main driver of climate change, primarily due to the burning of fossil fuels, like coal, oil, and gas, which produces heat-trapping gases.
Climate risk refers to investment risks resulting from unmitigated climate change. It is categorized as a systemic risk, in that it exists across all asset classes in a variety of different ways. Climate risk must take into account the highly uncertain yet potentially severe impacts on the physical environment wreaked by climate change, as well as the accumulated economic impact of failing to have recognized the negative effects of GHG emissions thus far. Investors may therefore face significant climate risk without even realizing it. Climate change is a systemic no-diversifiable risk and should be priced into all asset classes, particularly long-term ones such as bonds. Although some progress is being made with pricing to reflect climate outcomes, there is still a long way to go, which may result in mispricing of such assets in current markets.
Increased public attention and the accompanying preference of many investors for environmentally sensitive stocks boosts the price of those stocks and hurts those of companies that are big emitters of carbon dioxide, methane and other greenhouse gases, the scholars found. They also pointed out that this investor preference for green companies has made it easier and cheaper to raise money for environmentally useful projects. For one thing, the very preference of many investors for green stocks, which creates a measurable green premium, or greenium, that elevates their share price, which implies that these shares will have lower expected returns in the future. That's just what happens in financial markets when demand for an asset soars and supply does not. Its price rises over the short run, but, all else equal, it has less room for increases down the road.
Let's imagine that an oil-producing company has not changed its business model to focus more on renewable sources of energy. As societies use less gasoline, this firm may lose value. If many companies end up losing value because they aren't adjusting to a low-carbon society, then this could eventually spark some sort of market sell-off. If the transition to a low-carbon society happens without too much preparation, this can cause a kind of a shock to financial markets, Da Firmos said on CNBC. Every day more and more people are starting to invest in green stocks, and studies suggest that the trend is here to stay. Most companies that are into renewable energy witnessed a boom in 2021, in India alone, whereas most brown investments saw a decline. Green stocks are those companies that invest in environmentally friendly alternative energy resources. Brown stocks are just the opposite. Companies investing in oil and coal are known as brown stocks.
uncertainty and complexity, which characterize climate change investing when it comes to evaluating the risk-adjusted returns of a portfolio of assets, might prevent portfolio managers from building their strategic asset allocation around the climate theme. However, it is possible to use a different risk management framework, which considers diversification across sources of risk rather than per asset class, and which goes beyond quantitative evaluation.
The rate of global economic growth required for capital markets to be prosperous is dependent on the capacity of large developing countries like China and India to increase their social welfare and improve their living standards.
A carbon tax policy that would only increase the cost of energy would throw these countries into greater economic difficulties and threaten the stability of global capital markets. Therefore, a balanced and progressive policy mix needs to accompany such a tax.
To conclude, if more and more people realize that green is as good as brown, and it helps the climate as well, brown companies can bid their farewell. However, the argument remains. Are green companies green? Whenever we think of factories, the image of gigantic chimneys producing dark smoke clouds pops up in our minds. Can that be altered? Is it possible to produce something on an industrial scale and not create pollution? Thanks for watching the video. Please like and share my video and subscribe to my channel.